Hey everyone, welcome back to Corporate Decoder, the place where we unpack the confusing world of corporate finance and give you the straight truth. Today we are diving deep into a very special kind of SEC, filing a certified shareholder report from AuguStar Variable Insurance Products Fund Inc. And let me tell you, this isn't your typical financial statement. It's more like a financial buffet with a whole lot of different dishes. We'll be looking at what's inside this report, the story these numbers are telling us, and what it might mean for the company's direction. To get started, make sure you're subscribed and Fund Info appreciate getting straight insights from corporate documents. Join our Discord community linked in the description below. This report covers the period from January to June of 2025, so it gives us a snapshot of how these different investment portfolios are doing. Think of these portfolios as different baskets holding various investments for Insurance Products Fund Inc. and they have a bunch of these baskets or portfolios, and we're going to sift through the most interesting financial details you'll want to know. First off, the company behind this is AuguStar Variable Insurance Products Fund Inc., operating under the Investment Company Act file number 815-015. They've put together a report that shows us what's inside some of their investment portfolios as of June 30, 2025. Let's start with something everyone cares about: costs. For a hypothetical $1,000 investment in the AVIP bond portfolio, the costs for the last 6 months were about 31s there, being efficient with that particular basket. Now for some key numbers from the AVAP bond portfolio. As of June 30, 2025, their net assets, the total value of everything they owned, were a massive $463,393. That's a lot of money. They held 150 different investments and turned over about 19% of those holdings during that period. This turnover rate tells us how often they were buying and selling assets in that basket. If it's really high, it means they're actively trading. If it's low, it means they're octantly trading. If it's low, it means they're holding onto things for a while. Let's peek at their top 10 holdings in the AVFP bond portfolio. These are mainly corporate bonds, meaning they've lent money to companies. We see names like Marriott International, Ally Financial, American Express, Kinross Gold, Amgen, MPLX, United Health Group, Devon Energy, Hasbro, and Steel Dynamics. These companies are paying back the fund with interest, and these bonds make up a significant chunk of the portfolio's value. The percentages show these top holdings are generally between 1 and 1.3% of the total assets. Looking at the sector allocation for the AVIP bond portfolio, it's pretty diversified. They have significant holdings in bonds, which is expected, and then smaller percentages in communication services consumer, discretionary consumer staples, energy, financials, healthcare, industrials, information technology, materials, real estate, and utilities. This broad spread across different industries helps manage risk. Now let's switch gears to the AVAP BlackRock Balanced Allocation portfolio. This one has even more net assets, a staggering 370,485 holding. They are holding a lot more investments to 28 of them. Their portfolio turnover rate is a bit higher at 28%, suggesting more active management in this basket. For the AVAP BlackRock Balanced Allocation portfolio, their top holdings give us a clue about where their value is. Microsoft takes the top spot at 5.7% of assets, Nvidia is close behind at 5%, then Apple at 4.6%, and Amazon at 3.4%. Note a theme here, these are major tech giants. Meta and Alphabet are also in the mix, showing a strong focus on technology and communication services. This shows a significant bet on the tech sector, which has been a big driver of growth, but also carries its own risks. The sector allocation here also shows a heavy tilt towards information technology and financial services. This aligns with their top holdings and suggests a growth-oriented strategy. Let's quickly look at some other portfolios. The AVIP BlackRock Advantage International Equity Portfolio has $349 million in net assets and a very high portfolio turnover rate of 76%. This means they're actively trading within this portfolio. Interestingly, their geographical focus is heavily on Japan at 23%, then the United Kingdom, Germany, Switzerland, and France. This tells us this portfolio is designed to capture growth outside of the United States. In the AVIP Fidelity Institutional AM Equity Growth Portfolio, we see Nvidia at the top holding 11.7% of assets. This is quite a concentration. Amazon and Microsoft follow, showing a clear leaning towards these big tech players. Their portfolio turnover rate is 22%, which is moderate. Now let's zoom out to the big picture. What story do these numbers tell us? AuguStar, Variable Insurance Products Fund Inc., seems to be managing a diverse set of investment baskets or portfolios. Some are focused on bonds, others on specific market indices like the S&P 500, and some are managed by well-known names like BlackRock and Fidelity. What's notable is the heavy concentration in technology stocks for some of these portfolios, like the Balanced Allocation and the S&P 500 portfolios. This indicates a strategy aiming for growth, but also potentially exposing them to higher volatility if the tech sector falters. The bond portfolios like the AVAP bond portfolio and the AVAP Federated High Income Bond portfolio show a lot of holdings in corporate bonds, which means they are lending to many different companies. The fact that a big chunk of these are what's called restricted securities, meaning they can't be easily sold, adds a layer of risk to these portfolios. This means if they need to sell them quickly during a downturn, they might not be able to without taking a significant loss. This is a key risk to watch for. Compared to the underlying funds, their expenses are relatively low. For example, the AVAP S&P 500 index portfolio costs us only $19 for every $1,000 invested, which is quite competitive. This is often a hallmark of index funds where the goal is to simply track a market index with minimal costs. However, digging into the detailed schedules of investments, we see a lot of these corporate bonds are not easily traded. They are what they call restricted securities, exempt from public selling. This means if the company needs cash fast, they might have trouble selling these bonds without a big hit to their value. This is a significant risk factor, particularly in the high income bond portfolios. Overall, AuguStar seems to be managing a broad array of investments, some aiming for steady bond income, others for growth in the stock market with a noticeable tilt towards tech in some of their more aggressive growth portfolios. The strategy appears diversified, but the reliance on tech stocks in certain portfolios and then that concentration of risk with restricted bonds in others warrants attention. It suggests a strategy that's trying to capture growth but also carries inherent risks that investors need to be aware of. So what's the verdict? AuguStar is a complex entity managing money through various portfolios. While some are passive index trackers, others are actively managed with clear sector bets. The key takeaway is to understand the specific strategy of each portfolio you're invested in and be aware of the concentrations and risks involved, especially with those restricted bonds and the tech-heavy stock portfolios. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching and see you next time.